Hi, I'm Susan. I'm a real estate, Susan Warner-Lambert. I'm a real estate agent with Carbutti Realtors, and I want to introduce, come on over into the Zoom camera. This is Dina Rawling. Can you introduce yourself?
Absolutely. I'm Dina Rawling with the Carbutti and Company Realtors, and I'm a licensed real estate agent here in Connecticut and also in Florida for 22 years.
And then we have Dave.
Hi there, Dave Beckman from Guaranteed Rate. Been in the mortgage business for over 20 years. And I'd like to tell you guys what it takes to buy a home today. So thank you for having me.
So, so I have a question. Does anybody feel like they've lost out because on the low mortgage rate? Is anybody like, oh no, the mortgage rates have gone up, and like, oh no, I missed out my opportunity? Does anybody feel panicked about that? No? Anybody online? Okay, well, okay, so I'm going to ask a question. In 1982, what was the mortgage rate? Can anybody guess? Gladys, can you guess? Anyone? Anyone online? It's participatory. Well, in 1982, the mortgage rate was 16.04%.
People still bought homes.
Yeah. Yeah. So people buy homes because life happens. You know, people move, people get new jobs. You know, that's and you know, life happens. So people still are buying and selling homes. So over 45 years of mortgages, the average. Can anybody guess what the average interest rate is over 45 years? I know. Anyone online? We want to include you guys. Okay, well, the average rate for the mortgage rate for 45 years is 7.9. So it's almost shifted. We're almost to this a balanced market. It's still somewhat of a seller's market because of you know, the lack of inventory in Wallingford and Connecticut in general. But you don't have to go 30,000 over and waive inspections. You can almost go for asking price. You can also, you know, people are waiving inspections, which I would never recommend. You know, so now it's more balanced that the buyer has a little bit more say in the selling process. Would you guys agree?
Absolutely.
Okay. So, and then I know we're in Wallingford, so I just wanted to get what you thought you got, what the average median price of a home in Wallingford is. Can anybody guess? So it's $355,000, and that's for a 3-bedroom, 2-bath house, just under 1,500 square feet in Wallingford, and it's very popular that price range because those go fast in the market. So they're between 3 to 5 days and they're off the market because that's just a good starting range for Wallingford. Higher prices take longer to sell, and ones with only 1 bedroom, I mean 1 bathroom, they're like, oh, well, maybe not, you know, so they sit a little bit longer. So we have all this information that I can share with Leah if you guys want this, and she will be able to email that up to you. But I'd like to introduce Dave now to have him go through his mortgage presentation because that's one of the biggest key point of buying a home. So.
Thank you, Susan. So there's a couple things I'd like to just elaborate on what Susan mentioned. And one of the biggest questions we always get as a realtor and a mortgage banker is it time to purchase? Is it a good time to purchase a home right now? And just like Susan said, you know, rates are a little bit higher than they were the last couple of years, but they're still very good over. Oh, we get a little feedback. Okay, sorry about that. Is it a good time to buy a home? We said that, you know, interest rates are on the rise. They were historically low the last 3 years. We're probably never going to see that again. Could we? Yes, and that's the benefit of still buying, because when you own a home, you can refinance down the road if rates go down. So that's number one. Number two, they are where they've been over the average for the last 40 to 50 years. So we're approaching right around 7% for a conventional loan. FHA is a little bit less than that. But the reason, not only is the interest rate obviously important in your decision making, but your rents are going to go up as well. We're in inflationary times right now. So the benefit of owning a home is we don't have to worry about that rent going up. When you go into a fixed mortgage, the only thing that can go up is your taxes, property taxes, and most likely, you know, your insurance could go up as well, your homeowner's insurance. So, but many times it might be less than what your anticipated rent's going to be, especially for like a 3-bedroom home. And if you have a little bit more of a down payment, the more money you put down on home, the lower your payment's going to be. But I think one of the most important reasons of buying a home today is that safety and security for your family or raising a family. You know, you can, owning a home is part of a smart investment portfolio. And if you have a financial advisor, or if you're donating to your 401k, you know that's a good way to save for retirement, but home ownership is as well. And you can focus in on the market going down in terms of your 401k, and that's strictly transactional, and it kind of hurts when it goes down. When your home value might dip a little bit, you're living in it, and you're still raising that family, and you're still painting it, you're still having your friends over on the weekends, and that's the difference between, you know, owning a home and just strictly putting your money into your investments. And that's where, you know, home ownership is, you know, it's what America made America great, is home ownership spurs on all sorts of ripple effects into the economy. When you buy a home, you know, typically you might hire a painter or a contractor, and it just helps out everybody else as well. But it is still a great time to buy. And Susan, Dina can definitely find you the right home. That's you know, the key. So I'd like to just show you my home buyer presentation. And so we're up on the screen now. All lenders now are, let me start out with this. I'm a direct mortgage lender, meaning that we make our own loans. We have many different programs that I'll cover right in this presentation. And our rates are very good. And you also have an option of going to a bank. So many people, you know, they have their checking and savings account at their own bank, and they think it might be easier to get a mortgage. Often that isn't true. Banks are typically a little more conservative than a mortgage lender or a mortgage broker. They typically don't have as many of the programs that we offer. So like anything, if you were to buy an expensive TV or home entertainment system, you're going to shop around, and that's key with getting a mortgage as well. Whether it's with me or somebody else, you know, it's always a good idea to get a second opinion out there. So we have a digital mortgage application. It's really easy to fill it out online. That way, when you work with a lender like myself, we have your information right there. We can see what we're working with. That way, we can really start to dive in and see what programs will be the best fit for you and what you can qualify for. I'm just trying to figure out how to advance my page here. There we go. We have all sorts of loans that fit your life, because that's what it's all about. It always comes down to that monthly payment. Oops. There we go. So conforming loans, these are probably our most popular. This is also known as a conventional loan. The loan amounts can go up to $715,000 now. That's what the average price of a home across America, according to Fannie Mae and Freddie Mac, that's what we're willing to lend at the least amount down, and you know, with really low rates. So the key to buying a home is, you know, could be their down payment as well. So many people are under the assumption that they need 20% down. With this conforming loan, you can put as little as 3% down as a first-time home buyer, or 5%. Now, when you don't put down 20%, you're going to have mortgage insurance. Mortgage insurance has really evolved over the years. It's not as expensive as it used to be. And if you have excellent credit, it's very, very affordable. I'll give you an example. On a $400,000 purchase, you can put as little as 5% down, right? If you're not a first-time home buyer, even if you are 5% down, we'll just go with that. So that's $20,000. Compared to if you had to scrap and save and try to save up 20%, that's $80,000. So the difference is $60,000, right? So the mortgage insurance with excellent credit, and credit, we'll dive into that in a little bit, but excellent credit would be like a 760 or above credit score. You're talking about $47 a month to save $60,000 in your bank account, or maybe you never even had a chance to save it. And that's why you continue to rent, because you feel you need that 20% down. And that's where a mortgage bank can come in. These are some of the programs that we offer that can, set us apart from the bank, but also get you into a home sooner rather than later. Now, we have to make sure you fit into a debt to income ratio. So when you talk to a mortgage lender, we're going to ask 3 specific things. How do you rate your credit, what your income is, and how much money have you saved? The credit determines the rate. So the lower the credit score, the higher the rate's going to be. There are some exceptions to that I'll go over coming up. But the down payment amount, your income is what drives what you can qualify for. So we go off ratios, and typically it's 45% of your gross income can be used towards your new mortgage payment, your taxes on the home, property insurance, and then your home mortgage insurance if you didn't put down that 20%, as well as your car loans, student loans, and minimum credit card payments. So, for Connecticut to be a buyer in the Wallingford area, Susan mentioned the average home price is around $350,000. You probably have to make, if you have a car loan, maybe a student loan, you have to be making at least $35,000 to qualify for that type of home. If you make less money in that, then the home prices we're going to be able to qualify you for are going to be less. If there's a significant other spouse, then we can go, use that income as well, as long as they credit qualify as well. So that's the conforming loan. There is a government loans as well. Now, government loans are backed by us, the U.S. government, right? The FICO score requirement is lower on this. We can go down to a 580. I know my screen says 600. We have lowered it to 580. The rate's going to be a little bit higher, obviously, if you're a 580 credit score versus a 760, which is considered upper echelon. But this is still a way to get in to a home with as little as 3.5% down for an FHA loan. You can always get gifts on our programs as well. And that way, again, you can concentrate on home ownership and achieve that American dream. The FHA loan does have mortgage insurance, even if you do put 20% down, but typically people who get an FHA loan do not have the 20%. They're usually looking at 3.5% down. Mortgage insurance on an FHA loan is for the life of the loan as well. That's really the only pitfall of FHA. But once you buy a home with 3.5% down, there's a little equity there. And over time, your equity will increase. So as it increases, that's your opportunity to refinance down the road. Refinances means when you talk to a mortgage lender again, like me, and we can qualify you again, just like we did on the purchase, but we can get you a lower rate and you can move into a new 30-year mortgage, 20-year mortgage, 15-year mortgage, you name it. VA loans, these are very popular, obviously, with our veterans. This is a wonderful program designed for veterans. So if any veterans, definitely, if you haven't heard about them, find out about them. There is zero money down. The rate is below market. There is no mortgage insurance. Thankfully, our government, has a soft spot for veterans like they should. And, it's a great program where you can buy a home with zero money down. USDA loans, also a popular program. Well, unfortunately, Wallingford doesn't qualify. USDA is a rural housing type loan. So in our area of Connecticut here, the closest town that you qualify for a loan like this is like Durham. Think of a town with a volunteer fire department. That's typically who allows for USDA loans. And this is also a zero money down loan. So again, if you haven't saved up the 5% down or 3.5% down, here's an opportunity to get a zero money down loan. The minimum FICO score on that is a 640, so that's achievable by many. And then finally, we have the state of Connecticut. We have the Connecticut Housing Finance Authority, also known as CHFA, has a zero money down mortgage as well. And this one is very, very popular. And there's a couple of reasons why. Number one, the credit score is the lowest you can go is 620, but the rate is the same if you're a 620 credit score or if you're a 760, whereas all my other programs are going to be a difference in rate because of that credit risk. So number one, that's a huge advantage. Number two, you can actually roll in your closing costs with a second mortgage or down payment assistant loan. And that down payment assistant loan is at 1%, which is obviously very low. They also have a time to own program where there's a forgivable grant. This forgivable grant can get you $25,000 to use towards the down payment and the closing costs, or just the down payment if you want to pay for your own closing costs. There's a lot of options there. And in a very desirable area, Wallingford has certain parts that you can get up to $50,000 for the down payment, which actually is now a forgivable loan. So huge advantage where, our state of Connecticut through the Connecticut Housing Finance Authority is offering a wonderful program for first-time home buyers where you can get a forgivable down payment of up to $25,000, possibly up to $50,000. It is designed for first-time home buyers, and it is a little bit trickier to qualify for. Anytime we're looking at a zero money down loan, there's a little more scrutiny, but that's a job of a mortgage lender to make sure it's going to work, and that's when you get a pre-approval. So that is the CHFA loan. Often, Susan and Dina can tell you that you will get frustrated when you go out to look at a home because unfortunately the pictures look great online. And when you finally get to that home, there might be a few things that are absolutely turn you off. Well, instead of continuing to look at other homes, there are products that will allow you to rehab the loan. And again, this is through FHA and conventional. FHA you can do as little as 3.5% down of the after improved value. So maybe you find a home that's in the right neighborhood, it's got great bones, but it just is so outdated that you don't even want to put an offer on it. Ask a mortgage lender, and this is where I think we really stand out because banks do not carry this type of product. Many mortgage lenders do, not all, but we can actually finance in those costs of improvements into the home. So you can get your new kitchen. You can do as little as just getting the appliances. It's a wonderful product that just allows you to maybe find that property that just needs that work, and then we get the contractors in there, you get the quotes, we finance in those improvements, and there's a lot of potential options with this type of loan. It is owner occupied as well. One popular thing that we're seeing right now in the market is a 2-1 rate buy down. I mentioned that the average rate right now is about 6.875 for a conventional loan with good credit. There's a way for the seller to possibly pay for a discount in rate. And the 2-1 buy down stands for the rate will drop down 2% in year number one. So instead of paying 6.875, you'd be at 4.875. In my example on screen here shows that over the year, you'll save about $1,587. Each month, you'd save about $383 on a $300,000 loan. The second year will graduate up to 5.875. So first year was below 2%, then it graduates to 1%, and then finally that third year it goes to the normal rate today, which is 6.875. But even in year two, you're still saving about $196 a month. So that can really help out with cash flow, especially as a new home buyer, or maybe even somebody who's willing to sell their home and trade up to a new home. So the 2-1 buy down, ask your lender about that. Great program. There is a cost to doing that. Again, the seller might be able to pay for it if you negotiate it correctly with your realtors. You can also pay for it out of pocket as well. Just to give you an idea, $300,000 loan to pay for this program for that discounted rate would cost about $6,600 at closing. Any questions yet? Okay. The loan process, I mentioned, what we're looking for. So again, the three pieces of criteria is credit, income, some money in the bank, and then we dive deeper based on those answers. So first step usually is to apply for that digital mortgage. You can always call up your mortgage lender as well. You can make an in-office visit. But the key is when we make an in-office visit, we're really hoping you can bring some of your documentation so we can see what we're working with. So what we look for is typically a month of pay stubs, 2 months if your pay fluctuates, 2 months of asset statements. We have ways of getting that online now. 2 years of federal tax returns if you're self-employed or we go for a government loan. And then the contact for your HR person. Income can be tricky for many buyers out there because there's that borrower who is a W-2 employee, gets a steady pay stub or steady salary, I should say, been at the job forever. And there's always the commission people who may make commission plus their salary. There's people who make bonuses. We have to factor in an average of that. So if that pay tends to fluctuate, so then we don't put you in a position where you can't afford a mortgage. Nobody wants that. So understanding your income is really critical to getting a pre-approval. We'll pull credit at that time. We'll go over all your information, verify your assets. And if you're short, asset-wise, that's where we can discuss getting a gift. I think the key to that is you want to ask your relatives sooner rather than later to make sure if you can get a gift, what that amount look like. And we simply just need a gift letter. By the way, you are allowed to gift almost $14,000 now as a parent to a sibling, and that's tax-free. And your accountants always have different ways of figuring out how to reduce your tax burden on that. 5 steps for a perfect loan. So you got your pre-approval now. Now we can have fun, right? The pre-approval shouldn't take that long as we can get your information up front. So for instance, if you are self-employed, it might take a little bit longer because I'm going to need to see tax returns, most likely a profit and loss. That doesn't have to be generated by your CPA or accountant. That could be just from QuickBooks, but it could take a little bit longer on self-employed. If there's trust income coming in, that could take a little bit longer. What I mean longer is maybe a 24-hour turn time instead of a couple hours. Once you have a pre-approval in hand, now you know what you can target for a home purchase. And I think the key, in a rising rate environment is definitely continue to talk to your lender. They should be reaching out to you and letting you know when rates rise, so there's no surprises. And then you can go out shopping with Dina or Susan. That's when the fun begins, right? Because they can start showing you around, showing all your different options. Just to back up, when I mentioned income, I mentioned it takes about $35,000 to buy a home in Wallingford today. There are opportunities to buy a multifamily as well, and multifamilies can subsidize through rental income for what you qualify for. So if you're willing to look at a multifamily, and I always ask that as a mortgage lender, what your goals are. And sometimes first-time home buyers, nothing better. You don't have the peace of mind of owning a home yet, a single family. Why not look at a multifamily? And with a multifamily, you can put down as little as 3.5% with an FHA loan. So it's very achievable. And the chapter loan is still zero money down. And what can change after you start looking at the home with Susan and Dina is, I'm going to give you a ballpark quote based on taxes in the area you're looking at. But taxes obviously are going to be dependent on the home you're ready to put an offer in on. So once that happens, I'll update a pre-approval for you and I'll update a loan summary. Then we can make sure it fits. And then most importantly, I want you to know what your monthly payment's going to look like, as well as the amount needed to close, and just make sure nothing's changed. That's still doable for you. And that's when Susan and Dina can put in an offer. Keep our fingers crossed. I always try to reach out to the listing agent as well and just reassure that yes, this borrower is pre-approved. We did all the steps we needed to, so we're not going to have any hiccups, and therefore maybe stand out a little bit and help you get your offer accepted. Do you want to add anything to once your offer is accepted?
Okay.
I'll come back to the next step, but
Okay. I'm Dina Rawling again with Carbutti. I just want to talk to you a little bit about what Dave was saying. Now that Dave from Guaranteed Rate has got you all set up with your mortgage, now it's when Susan and I would go out and show you some houses. And of course, you've got your letter, so you know how much you can spend. This is the fun part. First thing you're going to do is choose your realtor. And now that you've got your realtor, you're going to go out and you're going to view available properties that are in your price range. And it's going to come to, you may go to see one or another. Like Dave said, some may need work, some may not, but you want to be sure that you're in your budget. You're ready to make an offer on a property. There's negotiations that will happen. So I'm going to walk you through a little bit of what happens. So you're going to have negotiations, and that's where your realtor will come in handy to guide you through everything. Now that you've negotiated with the seller, you're going to have your final contract at this point. After the final contract comes an inspection. You're probably wondering, why are we doing the inspection? We've already signed a contract. We've signed it for $350,000. And now I'm doing an inspection. What if something happens? Well, this is how it goes. You do have a signed contract, and I would never recommend not having an inspection, especially if there is a septic system in a house. You really want to be sure that that is inspected, but that is up to you if you want to do away with an inspection. But if should something come up in the inspection, then you go back to negotiating repairs. Say they need to do some work on the septic system, and I'm just pointing out the septic system. It could be the roof, it could be the electrical system, it could be plumbing, it could be whatever. And you would negotiate now, even though the price has been set, even though you've signed a contract, there is a negotiation period of time. That inspection must be done within 10 days of that original contract that was signed. So now there's going to be an amendment to the contract. But of course, you've got to do that negotiating. That is where your realtor again comes in to help you, to guide you the right way. Now there is also an option period for that. You only have so many days. I believe it's something like 14 days to get that all negotiated and have an amendment to the contract. After that, and it sounds like a lot, but this is why you need a realtor who is going to guide you through every step. Next, you're going to order an appraisal on the property. The mortgage company will deal with that, and then you'll go to your loan will go to underwriting. Now we're getting into the heart of everything. Everything is moving a little faster. You're getting closer to the day you're going to get the key to your new home. Mm-hmm. After the survey's been ordered, the buyer things are going along, so the buyer should think about turning on electricity or the power or filling, doing what you have to do on your new property. So that's just something to think about, because when you get the key and you want to go in and bring in all your appliances and everything, you want to be sure the house has electricity. The mortgage company will deliver the final documents to the title company. Your mortgage person is very, very important. As you can see, this is a joint effort that's helping you get to the point that you're going to get into this house that you've been dreaming about. The mortgage company delivers the final loan documents to the title company. The title company prepares a HUD statement, and then the buyer, now you come into play. The buyer brings the cashier's check to the closing. The closing will happen. And everyone has been, this is, like I said, a joint effort on your part, on the mortgage person's part, on the realtor's part. Now at the closing, you'll get the key to your new home. It's a lot, it is work. It's work on everyone's part, but the final thing is American dream, the home ownership. And Dave told you all the aspects of renting and home ownership. So congratulations, you bought a house.
Yeah, thank you. Yeah, so absolutely right. So Dina hit on a couple key topics there. So, usually when you're under contract, especially in the last 2 years, the seller wanted to close super fast. It's a hot market out there. So that's where, again, having a solid pre-approval, working with a mortgage lender that collects all your docs. We're always going to need updated pay stubs, updated asset statements. We have ways of getting your asset statements online if you opt in, but just as a shopper, just don't throw those things out because we're going to need them. The reason why we always need updated bank statements is Dina mentioned you're going to put a deposit on that contract that kind of holds your feet to the fire as a buyer. We want to give you credit for that as a lender. So instead of owing 10,000 to close, now you owe 10,000 minus that deposit that you made. And there's usually 2 deposits per contract, one before inspection, one after inspection. So pay stub, same thing. Whatever you do, if your lender qualified you on overtime, continue to make that overtime. Do not, take unpaid leave. And obviously, if you can't help it, just inform your lender. So again, there's not hiccups because we can't tell. We gathered all your information leading up to this point, but during the process, we also have to verify that you're still working. This really bit us during COVID, obviously, because a lot of people did get furloughed or what have you, and they didn't tell us. My borrowers that I was close with just didn't think that was an important piece of information. And sure enough, days before the closing, we verify that employment and the place is closed down. So thankfully, I think we're over those troubled times. So we shouldn't have to worry about that. Back to the mortgage process, that commitment, there's 2 very important dates on your purchase and sale contract. Obviously, your closing date, everybody celebrates. That's the fun one. The commitment date is the important date for me because I have to get your loan through underwriting and deliver a satisfactory commitment to allow you to continue to move forward. And again, it's just a timeline thing. So if this is a fast closing, your lender is going to really be on you to perform, to get everything in quick. 30 days is considered fast. There's a lot that goes into this. It's an orchestration of getting the appraisal, getting your homeowner's insurance, getting the title ordered through your attorney, and then finally the docs that we need for underwriting to make sure that everything is accurate. Unfortunately, there is fraud in my business, so we don't see as much of it. But again, we don't want to put you in a position where you can't afford a home. So documentation is key. Just let's touch upon large deposits. This can bite people as well. And it's totally innocent for the most part, but mortgage lenders consider large deposits different than the consumer would. Say you had money in the safe and all of a sudden you put it into the bank. That is a huge no-no because we can't track where it's coming from. To a lender, we have to always think you're borrowing money from Uncle Leo and Uncle Leo is going to charge you 15% interest. So we can't tell. We can't use that deposit of whatever it is, 5,000, 10,000. Another classic example that just came up with me this week is my borrower let his friend borrow money, and now his friend just finally paid him back. I can't use it. There are ways of getting around it. Maybe we can get a gift from a relative and, we can settle up afterwards, but just watch the large deposits. Another example might be, as you're getting ready to move, you might sell a dining room table or something of value. Really tough without receipts, and even with receipts, it's kind of skeptical. So just talk to your mortgage lender before you make those big deposits. There are some ways to get around it. Let's see. Nobody likes surprises. So thankfully, the rules for mortgage lending has really tightened up. I've been doing this for over 20 years, as I mentioned, and back in the day, there were some unscrupulous lenders that would add fees and add points onto your loan. So instead of thinking that you need 10,000 to close, it turned into 15,000. At that point, what are you going to do? You really want the home, and many people made it work. Thankfully, those times are over, and we have to disclose 3 days before closing what your final figure is going to look like. It has to be within a very small tolerance level, but that's good for you, the home buyer, to know exactly where you're at. So bottom line is, visas can't change. If they do for some reason, the lender always has to send you out disclosures. You have to sign them, and then so you acknowledge the change. And the only reason there would be a change usually is if your credit score dropped. Another example may be if you got pre-approved for a conventional loan, and then once that home inspection happened, as Dina mentioned, the septic failed and the seller didn't want to fix it, but you still want the home. Now we switch gears and we can go for what's known as that rehab loan. Obviously, your fees are going to change a little bit. The interest rate's going to change a little bit. So we have to always disclose that back to you, which is good. It protects you. Credit do's and don'ts. So credit is pulled in the initial stage, right? So you got pre-approved today, I pulled your credit. That's good for 120 days, but it may take you longer to find a home. I mean, some people, they want to start the process, and I always encourage people, even if you're thinking about buying in the springtime, get your credit pulled today, because there might be something that I find on that credit report that now we have time to fix. Usually people, if they're getting their credit pulled, they're going to find a realtor first. The realtor says, hey, did you get pre-approved yet? And that's when they'll refer, a realtor will refer you to their team. We work with the team because it's all about delivering excellence, right? That's how we grow our businesses, by hopefully doing a great job for you. And that's how you'll refer us in the future. But you go to Dina or Susan, mentions you need to get pre-approved first. We pull credit. It's good for 120 days. What to do during that time is just do what you continue to do. Pay your accounts on time. Don't miss payments. Don't make any large purchases. I'll mention another classic example is when people are under contract and I deliver that commitment, so we're just right on the finish line. They have all this money in their bank account. Maybe they got a gift from mom or dad. They go out and buy a car, or they buy furniture, but it's at 0% interest rate. It doesn't matter. We're going to see that credit inquiry coming in. Even if the credit card company says 0%, there's still a minimum payment, and that can goof up everything. And unfortunately, it can also not allow you to continue to qualify for purchasing. So no large purchases. Don't engage with any debt relief services. Always talk to your lender before you do anything if you have any kind of questions on that. Dispute on trade lines, just all that stuff you can wait until after the home is purchased. I want to share with you closing costs, because so far we mentioned down payment amounts. And just to recap, conventional, you can put as little as 3% down, put as much as 20% down, or even more. FHA, put down 3.5% down. There are zero money down programs like CHAFA with zero money down. But closing costs add up quickly as well. And in the market that we're in, the seller may be a little bit warmer to paying for some of the closing costs versus 3 or 4 years ago, when homes tended to sit on the market a little bit more. You could make an offer and ask the seller to pay the closing costs. So not only do you need down payment, but you need some of these other things as well. And unfortunately, they're it's a little bit small on the screen here, but I'll just go through them real quick. And lender, bank's going to charge a processing and underwriting fee, about $1,400. This person decided to buy down the rate to get a lower rate. That was $4,000. Appraisal fees, typically about $595. You need a debt report fee of $30 and a credit report fee. Prepaid interest depends on the day you close. That's kind of a moving target. Many realtors might say, try to close at the end of the month. If you close at the end of the month, a lot of times it feels like shopping on Christmas Eve. Like it is you don't want to close on the last day of the month. Close the day before or even 2 days before, just so there's not a rush. The attorney's usually busier. And the prepaid interest, on this particular example, we were borrowing $380,000 per day, costs $125 to, I'm sorry, 125, can't even see it now. It costs about $30 per day to live in a home. So And again, you get charged once you move in. So if it's 3 days before, you would owe $90 in that case. Homeowners insurance. This, the first couple of things I mentioned were part of hard closing costs. You're paying professionals to do work on your behalf. The other things that you have to pay for at closing are things you would have to pay as a homeowner, whether it's at closing or moving forward. And that's paying your homeowner's insurance and your taxes to the town. Homeowner's insurance is just like car insurance. You guys drive your car, you get your bill in the mail. Usually they want it paid in full for the year. They have some options on that. Maybe you can do bi-yearly or even quarterly. Homes, unfortunately, we want to see a paid receipt due at, paid at closing. Many times people pay for it just a few days before closing. We get the receipt. Now that you don't have to pay for that anymore. Homeowners insurance, like many things in today's economy, is going up as well. Figure about $120 per month for homeowners insurance. If you have a German Shepherd, a Pit Bull, what's deemed to be an aggressive dog, you're going to pay a little bit more. If you have a pool, you're going to pay a little bit more. It's all about risk. Also, your deductible. If you had a claim on the home because there was a fire or a tree fell down on it, and if your claim was only $1,000, that means you have to kick in the first $1,000 before the insurance company pays it. The deductible for the insurance would be a little bit higher, so it may make better sense. And likelihood you have a claim is pretty low, but if you are a good saver, you might want to make that deductible a little bit higher, so your insurance costs will be a little bit lower. If that is due up front, that's typically a big number. Right here, it's $1,500. Property taxes. This obviously depends on the home and the town. Wallingford is very good on property taxes, and it's due paying in arrears, not forward, where every other town is paid forward. At the end of the day, it's a pretty minute difference, but Wallingford will be a little bit less closing costs as well as Meriden than some of the surrounding towns here. But in this case, we were collecting 2 months of taxes and another 6 months. So that added up to almost $3,000 right there. You're going to need to hire an attorney in the state of Connecticut to close. We have some great referrals for you. Figure about, this is a high number here, but figure about $1,200. With title insurance and owners and title insurance, that $325 for owners, another $1,400 for the lender's title insurance. That just protects us, the lender, from any kind of title encumbrances or defects. It's required though. So you can see if this person was borrowing purchase price of $400,000, their closing costs added up to almost $17,000. And so now we need the down payment plus the closing costs, right? You can get lucky and ask the seller to pay some of the closing costs. Susan, I don't know if you want to kind of talk about any ways that might be an opportunity to ask the seller to pay the closing costs.
Well, it's structured in a conventional loan or an FHA loan that you can ask for a certain percentage back in the closing costs. So the issue, and when we're having a very hot market and crazy market, they didn't want to pay a dime, but especially FHA or the zero, they really wanted cash or the conventional mortgages. So, but now we're at a time where the buyer has more options and more leverage. But let's say you're buying a house for $200,000 and you want the closing costs. It's 3% on the closing costs, so you can get $6,000 back from the seller on the closing costs. You can offer 210 and get the 3% back, but the house has to appraise. So it's a little tricky. Like if the house prices at 190, it's not going to work. So it's variable, but certain loans have things built in that you can actually get the closing costs, and you just have to work with the seller. The house has been sitting on the market for a while. The strategy that it might work, and with today's market, it's a little bit easier to get that.
Exactly right. Another strategy may be that home inspection. You find a few defects, you go back to the seller. They're really not willing to get contractors in there. At that point, they might be willing to give you a seller's credit really towards those repairs, but we can use them for closing costs for now. Maybe the repairs aren't detrimental to be done. As soon as you move in, you continue to save, or maybe you have that money in your account already for closing costs and down payment, and you get your money coming back from the seller because of inspection issues.
And so, and now with the inspection issues, like when people waived their inspection issues and things came up, you didn't really have a recourse. But now if something comes up in the inspection and you want to walk away, they have to disclose it going forward. It's not something that, oh, they can hide it in the rug. The seller, they can't, like, I just had a home, have an offer on it. We opened up the electrical panel with inspection, there's water inside. That, that's a safety issue. So I'm not going to my suggestion always for buyers not to nickel and dime your seller, like, oh, this little thing. The safety, the structure, and the health of the home are the priority areas. So the safety of the electrical panel. There was an issue with the chimney with the flue in it, inside of it. And it needed, you don't want carbon monoxide leaking into your home. But if we walked away, they would still have to get it fixed or have some other credit. So we got the buyer to fix it, all of it for us. They have to show we professional receipts that these things are done. But because we had such a high, fast, and crazy market, the market now enables you to have a little bit more leverage and strength in making sure you can get these things taken care of. So even though it's a higher interest rate, you have more buying power in a different way.
I agree. Any questions yet? We didn't want this to totally be a presentation. If you guys have questions, feel free to.
Anybody online on Zoom? We're not forgetting about you. Just
Oh, okay. I see it one chat on mine, but you saw that. Oh, okay, very good. All right. So closing costs is, unfortunately, a lot of these closing costs are somewhat fixed. So whether you're buying a $100,000 home or a $400,000 home, it's going to be pretty close, at least for those hard closing costs. What will be different is the taxes, right? I think maybe the $100,000 home is going to have different taxes, property taxes, than a $400,000 home. That will help reduce the closing costs, but it is something that we're going to need in order to get pre-approved properly. That's where, if you don't have it, let's look at putting less money down. Let's look at maybe a zero money down loan. Let's look at rolling in the closing costs and actually financing them in, or maybe that time to own program, but we have that forgivable second. There are options out there, so that's the key. All right, so I appreciate you guys taking the first step in coming tonight. We can touch upon some more things as well. Hopefully, there will be some questions. But as I mentioned before, we're here for you. We all strive for excellence. We pride ourselves on honesty and accuracy, and this whole process can be really daunting. So we want to make sure that you feel comfortable with the process and you're aware of the pitfalls that can happen. I mean, I don't want to say every transaction is not perfect, but there's hiccups along the way. And I'm sure you've talked to some friends and you said, oh my gosh, that was a nightmare. It doesn't have to be, as long as there's communication, but there are things that come up. Susan mentioned the appraisal. There are some ways for us to finance in those closing costs without doing 100% financing, meaning if you found a home for 350, maybe you offer 360, but you ask them to pay 10 grand closing costs. So now you just went above asking price, right? As long as that home appraises out at 360, we're good. But if it only appraises out at 355, we can't get you, there's what's known as an appraisal gap there. And there's ways that we can hopefully get around that, not with 100% financing, but with if you're willing to put down a little bit of money with a conventional loan or FHA, you can cover that appraisal gap. Maybe the seller will go down a little bit and meet you in the middle. But those are the things that can come up that obviously we have no control over that. We do our best to, Susan, Dina are pros at figuring out what that property should appraise for, but they're not appraisers, they're realtors, right? So just keep that in mind. And then, as far as the mortgage process, it is a collaboration of, communication again, and just making sure that nothing's changed with your situation. I had a borrower the other day didn't tell me about they pay child support. And usually, as I mentioned, I send it to my digital mortgage application. I get all your information, and then I usually ask those questions. For some reason, I missed it too. Thankfully, we caught it. We were able to switch gears and lowered our purchase price a little bit because we can't avoid, child support unless the children's approaching 18 and we don't have to count it. But that being said, there's little ebbs and flows in the process. So, any questions for us at this point?
I have a question. I know you talked about having a pay stub, but what if you have a business and probably work part-time or something like that?
Great question. So, as I mentioned, income is one of the key pieces of getting a home because we always want to show their ability to repay. So, self-employment, and I think I just touched upon this right before you came in. Self-employment is a different animal because we want to look at 2 years of tax returns. You have to be in business 2 years, number one. And then we're also going to look like a profit and loss. And I always want to let you know why the banks are being kind of picky. Number one, it's the 2-year idea is because we want to see an average. We just came out of COVID, right? So I'm looking at a lot of tax returns from 2021 that were filed that are really low, but their profit and loss is on an upward swing again because they're back to their businesses is thriving again. The profit loss doesn't have a lot of weight moving forward because there's nothing that audits that. You can make up a profit and loss and hand it to me. I wouldn't know the difference. So that's why we have to look at 2-year average tax returns. And unfortunately, that can bite many potential buyers. Again, what's the solution? That's where I can try to help out. A solution may be to introduce a non-occupant co-borrower, mom, dad, sister, brother. Now, this really takes a heart-to-heart with my buyers. Like, I want to make sure that your business is back on track, but in order to use that profit and loss income or 2022 income, we would have to wait till you file taxes 2023. Maybe your situation doesn't really allow for that. So we could ask mom, dad, sister, brother to co-sign. And if that happens, that payment, as long as you can afford it, that is allowed, under the mortgage underwriting guidelines. Now they're going to have a mortgage on their credit too. So I advise my borrowers to kind of treat it like a business transaction. Give them a couple months of your mortgage payment to show that, if I ever get behind, here's my mortgage payment. You don't want to damage their credit, obviously. But then eventually when your tax returns come back and we can refinance you in the future and we'll get mom, dad, sister, brother off.
So would that affect, so if you have home buyers and they want to buy, they have to wait 2 years or a certain amount of time?
Another great question. So a lot of our underwriting guidelines are from Fannie Mae and Freddie Mac, and there's some guidance on this, and it's favorable. As long as you can show that you paid the mortgage, so you're the home buyer, paid that mortgage out of your checking account every month for 6 months, we don't have to count that towards their obligation, and that's key. It used to be a year.
There's a question online.
So, Kareem asked, I lived in the house for 16 years. There's something I can buy here that my home buyer is still quiet.
Hi, Jermaine. Yes, the rule is actually 3 years now. Sure. So as long as you haven't owned a home in 3 years, you can qualify for the number one program is the CHFA. That's your 100% financing, zero money down. We can roll in the closing costs, below market rate. There's a couple different options within that program that are very favorable, but that's what I would suggest. Go for that CHFA program. As a first-time home buyer, many lenders, a lot of times it's marketing. We have a first-time home buyer program, but really the only programs that are really designed for first-time home buyer is CHFA right now. FHA, you do not have to be a first-time home buyer. Conventionally, you do not have to be a first-time home buyer. I mentioned 3% down, which is a very low down payment for conventional. You don't have to be a first-time home buyer anymore. So